Eric, so we'll probably get going.
Yeah, so it's the top of the hour. I think we're going to go ahead and get started. So I want to welcome everybody to our latest webinar. Looking at the attendee list as everybody comes in, it's great to see the people, the names on here. I know we haven't seen a lot of you in person in a while. We have seen a few of you. We have a number of clients that are starting to come back in. But this is the world we live in, between David, Jake, Linda, and myself, in the world of Zoom, which I think a lot of you live in as well. So I want to welcome you today. So today is Wednesday, November 18th. So that means there's only 50 calendar days left in this year that we call 2020. And the world that I live in, that means there's only 30 trading days given all the weekends and the holidays. So it is going by fast. It's definitely difficult to find words to properly describe the kind of year that we've had. So a couple of housekeeping items for everybody. If you already haven't noticed, everybody is on mute for this webcast. So we continue to get people that are joining us as we go. We've got a great list of clients right now, so it's nice to see you all. So you can send us questions through the Zoom application. So if you hover over the window at the bottom of the screen, there should be a Q&A button that you can click and type in questions. Definitely encourage all of you to send questions as we talk today. I want to thank everybody who sent questions ahead of time. We've tried to incorporate those into our presentation. And if we'll try to get through all of them. So I want to go ahead and get started. So this first slide is the agenda for today. We're going to try to keep our prepared remarks down to about 30 minutes. So we're going to touch on the election, the economy, and really the implications on how that impacts, the investing world. So the next slide shows the timeline that we're currently in. So we're in the middle of this timeline. Everything to the left has already transpired, and as you can imagine, there's still some business to attend to. So we want to acknowledge the fact that the world we live in is very fluid at this point. There are a lot of unknowns going on right now. So during this webcast, we're going to try to provide some insight into what we feel the market has priced in. The market is always forward looking, and we're going to try to focus on policy, not politics. We wanted to provide you with a timely update, and trying to wait until everything was resolved would put us well into next year, and we just didn't feel like we wanted to wait that long. So really this next slide is going to frame the discussion for us today, what we feel the market is assuming at this point. So we believe that the market is pricing in a Biden presidency. We feel the market is pricing in a Republican Senate, and that the Democrats will continue to control the House. So we believe the market is determined that the divided government will continue at least for the next 2 years, and that there's probably not going to be a lot of change happening because of that. So as we move through the timeline that I previously referenced from left to right, if those things that the market is pricing in do not come to fruition, the market pricing is going to change, which means continued volatility. So with that, I want to start with David, turn it over, who will give us a little bit of an update to kick off our roundtable discussion today. So David.
Thank you, Eric. And your question of how do we explain what this year has been like? I mean, on the market side, it is, it's sort of the crazy market too. I mean, when I look at a year ago, if we were sitting here having this discussion, and I said, if we a year from now have 8 or 10 million people out of work, and the earnings for the S&P 500 drops by 17%, nowhere in that discussion would we ever say, do you think it's going to be at an all-time high for the market? And yet here we are. And that's, we'll talk about that in this discussion of why that is, from the Federal Reserve to the federal government, and the things that are, hopefully, as you talked about, is market forward looking. And what we saw was an epic drawdown in March, where the market dropped 30% in a few weeks. And then, once the stimulus started, it came back quite dramatically. Now, the last 3 months, what you've seen is it's sort of gone sideways. But when the election was over, you saw the market start to go up. Part of that is markets don't like uncertainty. An election is uncertain. Well, once it was clear what would occur there, and some of the assumptions, Eric, that you talked about were sort of put in place, the market started going up some. And then with the Pfizer and the vaccine stuff on Pfizer and Moderna, the market really liked that because it gave some hope to the market. And the market's always looking for good news to propel it higher. But I think we've had a great year in the market relative to what the economy and the world has done. But we'll talk about the potential for that going up or down. Now, if we look at the economic side, after talking about the market, we like to look at the unemployment numbers. And this is a chart that we've used off and on for the last decade, because on the left-hand side, it tells you the percentage of employment, job losses that we've had from peak employment. And the blue line, which we talked about a lot, the employment recession in 2007, is that it lost a lot of jobs, but it took nearly 80 months to get back to even, because that was a structural recession where the financial system was imperiled, the real estate market was imperiled, and so it took a long time to recover from that. The good news is this is an event-driven recession. The bad news is it's a really bad event. And what you see is it dropped precipitously when the lockdowns occurred in March and April and May. It's come back quite dramatically from that, but when you look and the red dot is sort of an updated number there, but you're still talking about 8 to 10 million people that had a job in February that don't have a job today. So we think that will continue, but it will probably not be as dramatic an upturn, but it's not going to take us 80 months to get back to where we were. So there's both good and bad there. The vast majority of Americans, probably 80–85%, are better off today financially than they were in February, because they didn't take the vacations, they took the stimulus, they paid down debt, they didn't go to bars and eat out as much. And so financially, about 80–85% of Americans are in a better financial shape than they were at the start of the year, but 15 to 20% are not. So that's where we sort of are from the employment side.
And David, we're going to need to see continuous improvement in these numbers for both the market and the economy in order to get back to normal, or whatever the new normal is going to look like. And we may be seeing some light at the end of the tunnel, right? So as you mentioned, just in the past week, we got some very positive, good news from both Pfizer and Moderna regarding a vaccine. When do you think we're going to see those start to be distributed? How fast can this move us towards that new normal?
Well, you're exactly right. The light at the end of the tunnel was those vaccine numbers that came out. I mean, when you look, the original goal of those vaccine companies, those pharmaceutical companies, was to have a vaccine that would be 50 to 60% effective. Both of them have more than 90% efficacy. And the good news is Pfizer came out today basically saying that they have their safety data. So they will now, as soon as they put all that together, will be able to go to the FDA for emergency approval, which will be before the end of the year. And so you could see by the end of the year, some of the vaccines starting to be put out. And as you see here, and we've only listed 5 of the companies, there are dozens of companies around the world that are working on vaccines, and probably a lot of them will be, will be effective. Now, when you look at the different types, the first 2 are a type that's called a messenger DNA. Some of the other ones are in pill form. So, but when you look at 7 billion people that they're going to have to get this to in emerging markets, in developed countries, in Europe, in Asia, and the US, it's going to take a while. I think you're going to be looking, even though we start at the end of the year here, I mean, it may be the summer before it's widely available, and it may be, near the end of the year before it's around the world. So there is some really good numbers here and good ideas that, you know, we're going to make it through this. The question that you also have, and this is what Pfizer said today, we know it's effective, we know it's safe, but we can't tell you how long it will protect you from.
And obviously with it taking that long for it to get mass distribution, we're going to lose some people in the meantime. But there was also some really good news out from Eli Lilly this week.
Yes, and that was on therapeutics. Eli Lilly came out, and it got overshadowed because everybody's looking at the vaccine, but it was a cocktail of antibody drugs that was going to allow, in certain cases in the study they did, about a 70% reduction in the hospitalization. And that's really the big concern. I mean, when you looked at New York back in the spring, I mean, the problem was not just how many got sick, but they overran the healthcare facilities, and people with normal problems, heart attacks, strokes, those types of things that come in, you know, they couldn't get treatment. And so more people die if that's the case. So it was a very good information coming out, and it was, the FDA approved it. It wasn't, oh, we've got a study going. It was, here's an approval for that.
Yeah, we've obviously learned a lot since this all started, and this is super hopeful, and the markets have met these developments with a lot of enthusiasm. But while we can see the light at the end of the tunnel, the implication is that we're still in the tunnel, and so still at some risk. Now, here we are going into the fourth quarter when we often talk about a Santa Claus rally in the markets, and that's a typical behavior at the end of the year. I don't think anything about this year would be categorized as typical. And we're also going into flu season, right? So with the holidays and gatherings, large gatherings, talk around my household, as I'm sure it is around many, is what do those holidays look like this year? Are we doing a gathering of family and friends under roof or via Zoom? So the news lately has been a little less positive in that regard, driven by a lot of rising cases of COVID. So what are we seeing here, and what does this potentially mean for the recovery?
Yeah, you're exactly right. I mean, we're clearly in the tunnel, and it's very dark in the tunnel right now. If you look at the first two on the left, those are daily tests and daily cases. I don't pay much attention to that. What I pay attention to is hospitalizations and deaths. You're not in the hospital because you took a test. You're in the hospital because you're sick. You don't die because of a test. You die because you got sick and died. And you're seeing all-time highs on the hospitalization. Now, the good news is, if you look back in the first half of the year when this occurred initially, the death rate has gone down dramatically. One of the data points from Europe was that in June, your risk was 8.3% of dying with it if you got it. And today that's 2.3%. And I'm sure it's similar here, probably a little bit lower here because Europe has an average, an older population on average. But so fewer people are going to die. But when you see an all-time high in hospitalizations, it is very concerning. And the deaths lag that. But I could see us going up to 1,500 to 2,000 people a day dying before we get the vaccine and before we get treatment. So it is ugly still out there, and not to sugarcoat it at all, but we do see that there is a way out, both on the treatment side and the vaccine side. It's just getting to there.
Yeah, I think the other thing is there's a strong correlation with cases and where you live, right? The temperature and the climate. So I think one of the big concerns that we have going into the end of the year here is, do we get additional lockdowns similar to what we saw, March and April? I think that's one of the big concerns.
Well, I think you will have some restrictions imposed, but the good news is I don't think you'll have the lockdowns that caused a 30% plus drop in GDP in the second quarter, because basically factories shut down, offices shut down, everything shut down. Well, now we figured out how to operate a factory with protocols and make it safe. We figured out how to work from home. I think where you will continue to see some problems will be in the food services, the hospitality areas, those areas, gyms, that you're going to have a problem there. They're a much smaller part of the economy, but I don't think you're going to see the widespread drop in GDP that you saw in the second quarter. Overall, when you look for the full year, I think you're going to be a -5% or so GDP, which is very, very bad, but we're starting on the upswing.
Yeah, well, I love that businesses have had to innovate, right? I mean, everybody has had to do things a little differently. And I love that analogy of the tunnel, and that we're still in the tunnel. I think that's a good analogy. The other analogy we've used has been this bridge, and kind of going back to this, we showed this last time, which is, the virus has really caused just a hard stop on the economy, right? I mean, unemployment spiked, as you showed, and it's created this chasm or this canyon that, we're trying to figure out how to get over. And governments and central banks is what we think is the bridge to get us there. And we saw it earlier this year where the government passed a stimulus. I think it was about $2.5 trillion that they passed to, and they did direct payments to individuals. They did the PPP loans to businesses. So I guess the question now is, do you think we need additional stimulus to have this bridge fully get us over? And if we do, what does that look like with Biden as president and a split Congress?
Well, I definitely think we need additional stimulus. I think the market has priced it in. Now, will it be a $2.5 trillion stimulus that the Democrats had proposed, or will it be a $500 billion stimulus that the Republicans in the Senate had proposed? With a divided Congress, it's going to be somewhere in the middle. And I think this chart basically shows what people said, well, if it's a Democratic sweep, here's what it's going to look like. And if it's a divided government, here's what it's going to look like. I think our politicians, as with the elections over, I think in the next 3 to 6 months, they will get something put together. They may get it put together before the end of the year. And maybe they'll do what actual politicians should do, which is do what's right for the economy and the country without worrying about an election, and come together and put something. But we will need that because, and I think it will be more targeted, Jake, than it was in the spring, as you talked about. In the spring, it was use a shotgun blast and blow money out into the economy because we got to get it out fast. Today, and like I said earlier, a lot of people are better off because they got $1,200 that they didn't think they were going to get. Those people that had a job, they probably didn't need the $1,200. So this time it will probably be more focused on unemployment insurance, those 8 to 10 million people that are out of a job, basically for no fault of their own, but a health issue. And I think there'll be some small business, additional small business disbursements, and probably some industries like the hospitality and travel industry will get some additional money, because some of those are going to go bankrupt before we get to the other side of the bridge if they don't have some help.
Yeah. David, we're getting a question from the audience, a few different questions. I'll try to summarize. So if you went back to the slide where we had obviously a big downturn in the March-April timeframe, do you attribute the kind of that V-shaped recovery solely to the stimulus? Is that why we came out of that so quickly? Because you look May, June, July, we were still wondering if we were going to get a vaccine at all, and how long, what that would even look like. So do you attribute the bounce back to the stimulus? And if we get another stimulus, do you have another continued run like we did?
I think the stimulus helped a lot, especially on the PPP loans to small businesses, where they said, and actually even the ones to the airlines and some of them, where they said, we're giving you this grant of money or loan of money that's forgivable, but it's dependent upon you keeping your employees. That actually got people coming back and actually rehiring. Part of that also was not so much the stimulus, but it was on the manufacturing side, and even on the, on some of the service side, where companies had to figure out how can we safely operate. Once they could figure that out, then they said, okay, let's get back to work. But I think if you don't have the stimulus, I think the stimulus is not going to cause another big jump. It's just going to keep that from not going down and continuing the slower trajectory up. But because if we don't get the stimulus, I think you're going to see another leg down. So I think the government will do that, or there'll be some bad economic consequences of that.
Yeah, it definitely seems like too, when you talk about the government doing direct payments and loans and being targeted, I think the other thing that we could see is infrastructure spending. I mean, in past recessions, it seemed like we'd always go to a war to kind of create spending, right? And and now that may be, you know, you look at Trump, that was one of the things he wanted to do is an infrastructure bill. Biden seems to have a similar plan. So I guess, Dave, do you feel like infrastructure is needed now, some type of package like that, and why would it be important now?
Well, I think it is needed. It's not as critical in the short run as a stimulus that keeps unemployment and some of the small businesses going. But I do think you're exactly right. President Trump, in his platform in 2016, wanted to have a big public works project, an infrastructure project. President Biden or Vice President Biden, he has it in his platform. So I think there's bipartisan support. And I actually like infrastructure type spending because it's not, I'm going to send you $1,000, go out and spend it, and it's gone. It's, let's spend $1 trillion to upgrade our roads, our bridges, our railroads, our dams, you know, all of the things that make us more efficient as a country. And I think you can look around the world, and if you look at China and you look at India, similar populations, similar educational levels and stuff, and yet China has done phenomenally well in growing their economy because they've spent trillions of dollars in infrastructure, and India has not. So you go to India and want to operate in a business, logistically, it's a nightmare. You go to China, that's why we get a lot of stuff from China. They can get it here quickly and efficiently all around the world. So I like it from the standpoint of we spend $1 trillion. It's not poof, it went out the door and we never see anything. We spend $1 trillion on infrastructure. We get benefits of that for decades. So I like it, and I think it will occur, probably not as fast as the normal stimulus, though.
So when we talk about infrastructure, I guess, China has done an amazing job of that. One of the questions I always kind of think about is, infrastructure historically has been building bridges and roads and things like that. It seems like China is now pivoting a little bit to some of these emerging technologies, whether it's 5G or, artificial intelligence, things like that. So if an infrastructure bill were to be passed, I mean, do you feel like there'd be some of that built into it?
Probably not from the standpoint of here historically, we've had private industry do that, where on the bridges and roads, it's usually government paying for it. In China, it's a little bit different because they've got a lot of state-owned enterprises where the central government that's, communist says, hey, we want to do 5G, go do it. And they control the companies. So probably less of it. I think there's so much demand for the artificial intelligence and 5G stuff by businesses and individuals. I think that will come just through the capitalistic system of I can make a lot of money if I do that.
Yeah. Well, the mantra this year has been don't fight the Fed, right? I mean, we've seen the central bank, basically the Fed, take interest rates down to zero or near zero. They've added $3 trillion to their balance sheet. Lately, we've seen interest rates come up just a little bit. The yield curve is starting to steepen. So what's your expectations on the Fed and just interest rates going forward?
Well, I think on the Fed, I think what you're going to see is, they're going to continue to make rates stay low. I mean, they, Linda and I have talked a lot about it of, going back, 12 years and seeing them, jump up dramatically. And I think they're going to continue to, for the next 2 or 3 years, keep rates very, very low. And a lot of people say, well, how does that help me and how does it help business? Well, businesses borrow a lot of money. And so if rates are low, it's easier for them to borrow money. It's cheaper for them to borrow money. But for the individual, when you look at a year ago of 3.5% to 4.5% mortgage rates, and you look today at 2.5%, 2.25%, I mean, that's huge, because it's not a one-time shot of, oh, I got a 12-month loan. These are 30-year loans, 15 and 30-year loans that for years people will have hundreds, if not thousands of dollars per month in relief from a lower mortgage rate. I mean, it blows my mind that somebody would lend money at the inflation rate for 30 years, but that's the world we live in. So I think that's actually a very big, good thing for us.
I remember as well sitting in your office back in 2008 and just being stunned by the fact that the Fed balance sheet was going to tip over $1 trillion for the first time. And just that the size of that number seeming so unbelievable. And here we are 12 years later, 7x that amount, and throwing the word trillion around like it means nothing. But that's the Fed balance sheet. On the flip side to that, or complementary to that, is what's going on with the federal deficit. We were at $10 trillion back in 2008, just for comparison, and now over $27 trillion in debt. The question I hear all the time, and I think we've seen it come up on our question panel already, is who's going to pay that back, right? Does this mean higher taxes? What does this mean for inflation? How do we get out of that, and when?
Well, and higher taxes, the interesting thing, we had the Tea Party that was, we've got to get the budget under control and debt under control. I mean, it's like they all took cyanide and died, even though they're all still in Congress. They just, had this amnesia and they forgot about all that. And so basically for the last 12 years, you haven't seen anybody that's concerned in any way of the federal debt. They should be, but they're not. And so I don't think you're going to see higher taxes in the short run, because nobody is concerned about it. And with a divided Congress, you're probably not going to see higher taxes a lot here because of that. But I think there are long-term implications. Is it going to be inflation? We've talked about that for a long period of time with the Fed balance sheet and the deficit and the federal debt like it is. But we haven't seen that. But, you can't manipulate, economic principles long-term and say there's no cost. I mean, there absolutely is. When we pay that cost and what the cost, how it's going to show up, whether it shows up, if you look at Japan, it showed up of anemic growth and negative growth in a lot of years. Whether that's going to be us, I don't know. But there will be a cost later on. I just don't see it probably in the next 2 years.
So I guess one of the questions is how does this turn us to, when we look at our portfolios and what we're doing, what's the impact there? I think that's one of the big questions that clients have, is what are we doing based upon that, whether it's for inflation or, COVID and things like that. So.
Well, we've probably been more active in the portfolio because of our strategies this year than nearly any year I can remember, because it's been such a crazy year with ups and downs. I mean, if you look at total return, the bond strategy on the left-hand side, the lowest risk, I mean, we were 100% cash in that in early March. In the core equity ETF, I mean, we were 60% cash, and then things turned around and we went back in, fully invested. Rotation has, been to short-term bonds. It's got some international small cap in it. I mean, there's various areas that have moved quite a bit. Now, one of the things that we are seeing, and it's really interesting, because nearly everything in the last decade, if you look generally, I mean, there's been pockets when and time frames where something did different, but generally tech and large cap growth US has dwarfed the returns of nearly everything else in the world as far as stocks. And what we're seeing, it's really interesting, the last month or so, month and a half, you're starting to see some of the value stocks that just got really beaten up in this pandemic starting to come back. And we saw it especially after Pfizer announced their vaccine data. Because if something did really well in a pandemic, which the tech companies did, because people are using Zoom like we are in millions of applications, and a financial company didn't do well because interest rates went down and people lost their job and nobody's borrowing. If you flip that and say, oh, we've got a solution, we've got a vaccine, what's happening? You're seeing a flip of that. You're seeing financials, travel, healthcare, hospitality, all of those going up a lot more than tech. Whether that's a short-term or a longer-term trend, we'll have to see. And I think you'll start seeing some of those names, and we have seen some of the healthcare stuff show up in the 5-stock strategy and some of those. But there are these cycles of what is doing better. Same way you look at on the international side, I think Asia has done much better on the pandemic than we have, and Western Europe. And what you're seeing is some of those markets are starting to do better. So we'll see. I mean, I think this has been one of the things that has shown us why we like our models, because it takes the emotion out. You don't, even though you want to crawl under the bed in the middle of March, the model still says, here's what you should do. And it makes it easier for us to say, yep, the model's got an edge. That's what we're doing. And it doesn't mean that we don't feel bad when the market goes up and that we're not elated when the market goes, up or down. Sorry, got that little flipped. But that's the way that's the way this year has gone. Today it's up, tomorrow it's down. But it helps us manage that, and that's why we have the models.
Yeah, it's interesting when you talk about value versus growth. I mean, one of the things I've noticed is when you go back and look at growth, has kind of outperformed a value really since the 2007 to 2008 time frame. It usually seems like over that time frame, it's only the value only outperforms by 2 to 3 months on average, and then it kind of falls back, and growth has been the thing that's trended. So we continue to wait for that trend to be a long-term trend. It just seems like value's been a very short-term trend here and there, and I thought that was kind of interesting that you said that.
Yeah, no, absolutely.
But yeah, markets are moving faster. I mean, this year it seems like we've had to, continue to refine and tweak the portfolios just to stay, ahead of the market a little bit. I think one of the things that we continually have to ask ourselves is what's going to surprise the market here, and so we just want to maybe outline a couple of risks that we see. One of those being no stimulus, and maybe that chart or that slide should say less stimulus, because I think there's a low chance that there is no stimulus. But when you look at this Georgia runoff, I think that could be something that could delay stimulus a little bit. The vaccine, the fact that we've gotten good news on the vaccines, I think one of the things we've looked at is that maybe we don't need as much stimulus if progress continues to get made there. The market seems to be pricing in quite a bit of stimulus, and if we have less than $1 trillion, let's say, that's probably a material disappointment when it comes to the market. The exponential COVID spike, that certainly could be one thing. I mean, additional shutdowns, the market seems to largely be ignoring it, primarily because of some of the vaccine information. Central banks, that's kind of the other piece. There's high expectations, I guess you could say, for a large amount of quantitative easing. And it's not just from the Fed. I mean, it's worldwide. So, if the Fed has to quantify what they're going to do or tell us, when this is going to end, I think that could be something that could disappoint the markets a little bit. And then the other thing is political surprises. I mean, we talk about the election's not completely over, so there's legal lawsuits that are occurring that could change, potentially the election. You talk about Georgia, we think both Republican senators, or at least one of them, will win that, and that's why Republicans will maintain the Senate. But those are things that could certainly cause a spike in volatility, and maybe maybe some unknowns.
Jake, a couple of questions that we've gotten that I think that would potentially be a risk. And Linda, you and I have talked about this a lot, is more on the real estate side. So we've had, I would say, another run up in housing prices, and there's been a lot of government intervention that is set to expire. And so I think one of the questions is that something that would overturn the market a little bit with just the potential impending real estate market?
I think we're gonna have to wait to see that one. I think there's a lot of bubbles going on in various parts of the market right now, and real estate's certainly one of them. And on the one hand, you have individuals who for the last 9 months have been locked up in a small condominium with 2 kids, a dog, and now winter weather, probably additionally motivated with the lower interest rates to find something bigger and more spacious if the work from home phenomenon is going to continue, and we expect it will. By the same token, we don't know what that real estate market is going to look like, because in January we start to see the eviction notices expire finally. So how many people are living in a place that they are not going to be allowed to live in following, unless the eviction moratorium is extended? And then on the commercial side of the equation, you have businesses trying to get out of commercial leases as fast as possible. Again, in anticipation that the work from home phenomenon is going to continue to be the way forward. So still some unknowns there and some bubbles appearing.
Yeah, and I think even if we look at all of these risks, even if we were not to get any of these things to really disappoint the market, I think one of the other risks that we got to look at is how much of the good news is already priced in or baked in. I think that's one of the big concerns is, we've had a really good year in a year that we didn't think we would. Does next year, is it flat to down because all the stuff's kind of baked in? But so that's one of the things we continue to kind of look at. I think, Linda, why don't you walk us through a little bit of maybe some of the upsides or tailwinds that we see?
Right. So if those are the headwinds, the possible tailwinds that we see, which could continue to drive us actually in the right direction or further ahead. Accommodative Federal Reserve. They have been very clear in telegraphing this all year long. All you have to do is look at what happened to their balance sheet for the 6 weeks back in March, April timeframe. It went from $3.5 trillion to $7 trillion. Extraordinarily accommodative. They don't appear to be stopping the printing presses, and to be clear, that's printing of money, right? And keeping interest rates low for a very long time. An average 2% inflation rate is the target now. That means we could be years and years of certificates of deposit at less than 1%. Money market, basically, it costs them more to send you your statement than you actually make in interest on the account. So an accommodative Fed, don't fight the Fed, all positive for the next year. Economic conditions are improving. Yeah, we have 6.9% unemployment, but that's a far cry from the 15% unemployment where we were. And we're starting to see more job openings, and hopefully the first time claims for unemployment number coming down. Obviously, vaccines and therapeutics have been a big part of that boost and will continue to put a positive spin on the market for next year. And then, Jake, I hear your point on stimulus, right? Is it going to be $500 billion or a full trillion or more than that? Honestly, I don't think from a direct payment standpoint, it matters for the market. It matters obviously for the individuals who are sitting in food lines, but I think there is bipartisan support for infrastructure spending, as we've been talking about. And I think that gets passed. Now, how fast it gets into the market and has a positive impact remains to be seen. But I think there's plenty here that says that things can calm down and we can see some positive momentum continue in the markets.
So we've gotten a couple of questions during the presentation today, and I know we've had a couple of people prior to the presentation send in kind of a similar question about, given all of the unknowns, some of the things that Jake talked about on the previous slide, why aren't we in more cash in the portfolios, or should I be holding more cash, given that it seems like there's still a lot of uncertainty going on? So I think that was kind of the flavor of the question. So I don't know if we want to talk about that a little bit more.
Well, you know, if you're having trouble sleeping at night, because obviously the world is a very uncertain place right now, then having some cash on the sidelines is your way of sleeping at night and feeling safe. That being said, all of our models and everything, all the tea leaves that we're reading right now have us fully invested. And we see a lot of reasons to be positive in spite of the volatility. So we're fully invested here in our models, and we'll allow our models to direct us otherwise. What else have we got?
One of the other questions that came up is, and Dave, maybe you can touch on this, but what do we think about the big reset theory? That's kind of
Well, I mean, this is always the question. People look at bull markets and expansions, and then recessions and bear markets, and then the reset going forward. I mean, when you look at that, I mean, the question is did we really go through a bear market, and was it a real recession? I mean, the numbers clearly indicate that, but we've never had something like this where it was shut down because of a health scare, not a health scare, a health issue, and where you've just shut down an economy worldwide. I mean, it's never occurred. And so, is this a reset? I think there will be some reset pieces, like Linda alluded to. I think there are. If I were in the airline business, I would be concerned. I think you're going to see businesses that were where the airlines made their most money. A lot of businesses that are going to say, we don't need to fly everybody in for that meeting. Let's just do a Zoom meeting. So a hotel, a rental car, an airline, I think there's some real changes there, which then translate, if you're in the rental car, or airline, or hotel, it sucks. But if you are in that business, all of a sudden my costs, my expenses have gone down. So my profit has gone up. So there's some pluses and minuses to that type of a reset. And the question, if I'm a retailer that have brick and mortar stores and not much on the internet, I potentially have a real problem. So is there a reset occurring? I think in some industries, yes. Some probably it will be nuanced of, yes, there's some change, but not dramatic.
Yeah. So we touched a little bit on the fact that with a divided government, we don't expect any broad sweeping tax changes. But we have had questions around some specific components of the tax. Do we feel like maybe the capital gains tax rate may change by itself, or the SALT deduction limits changing, or maybe smaller parts of the tax code changing, or is really any tax related change at least 2 years out?
Yeah, I mean, when I look at that, I think no major tax increases during that time frame, because I don't think you'll get an increase through a divided Congress. There may be some targeted things where you can look and say, well, I think they could agree on this or that. On the SALT, and that's the state and local tax deductions, where it's limited to $10,000. Initially, when that was first passed, it was, this is going to only affect those people that make lots of money and are paying more than $10,000 in state income tax, which in most states would be $200,000 or more. But what you're finding is when somebody has a house, and house prices, as Linda talked about, have gone up dramatically. If you make a decent income, and you're especially in a high real estate tax state, or your house has gone up a lot, you can easily be brought into that you don't get the full deduction, that you're limited to the $10,000. And I think there probably is some bipartisan support for that, not a tax increase, but a tax decrease. And you may see some decreases in some targeted middle class stuff, but I don't think it changes much on the capital gains tax at all, or the estate tax, at least for the next 2 years.
Yeah. What about on another question comes up is just pent-up demand. I mean, pent-up demand in consumer spending specifically, more post-pandemic. Hey, things get better. whether that's airlines, restaurants, things like that. What do you see there on pent-up demand?
Well, I think it will depend upon the type of demand. So if in the last 6 months, I didn't go out to eat at all, we get a vaccine, I'm not going to eat out normally and then get 6 months worth of meals in the next 6 months in addition. But if I didn't take a vacation this year, I may take 2 next year, or I may spend more on it next year than I would normally have because I didn't take one this year. I think you will see some pent-up demand. Like I said, probably 80% of Americans have more cash in their checking account or savings account than they did at the first of the year. And, I mean, we're Americans, we spend money. And so I think you'll see that.
I think we could make an easy argument that this is probably one of the best retail seasons this quarter. I know the retail numbers were down last month. We have no place to go and we have nothing to do and we're not spending money on eating out. I think this is going to be a very good Christmas for a lot of kiddos because we got nowhere else to spend our money.
Well, globally, I think that you're exactly right. Also, I saw a thing out. So China does this Singles Day. It's sort of a Black Friday, but for singles. And Alibaba, which is sort of the Amazon over there, they had $76 billion in one day. I mean, just blows your mind how much. And I think you're right, Linda. I mean, people want, if I'm not going to travel someplace, I'll just spend more on Christmas or on Thanksgiving. So I think once we get out of here, I think there will be pent-up demand.
So I'll try to collapse a couple of questions. Are there changes in our portfolio that we've done around kind of some of the emerging technologies that Jake talked about? You have a lot of car companies that are starting to come up with electric only cars that's going to be in the next 5 to 10 years. You have a lot of new emerging technologies from an environmental standpoint. Those things have been talked about in different aspects. Are we seeing changes within our portfolio, within the models, to start to take advantage of some of those new industries that could be created? A lot of people look at it, what the world looked like pre-pandemic and what the world's going to look like post-pandemic. Are we starting to make that shift within our own portfolio?
Well, I think what you're seeing is in fact, anybody that's in the 5-stock momentum has seen the best trade that they've had this year has been Tesla. We don't target that of, here's where we want to be. We let the market tell us where we should be because the models are based upon that the market price will tell us where we should be. So if the trends are positive, and you saw that during the pandemic, you saw Apple was in some of the strategies. You saw NVIDIA, which does graphics chips that are used in all the video game consoles and a lot of other things. But you do see those come in. You're probably going to see more pharmaceuticals in some of those areas because they will start doing better and have been doing better. Linda, do you want to add anything there?
No, you did a good job.
All right.
You saw it with Lululemon too, right? Everybody.
Yes, exactly.
Comfy clothes, right?
Yep.
On all the gaming technologies, right? We're looking for places to spend our money.
Yep.
So I think, did you see any other ones, Eric, questions that came through?
Yeah, no, I was just trying to call through. I know we probably didn't hit every single one exactly.
I guess one of the other questions that did come up, just talking a little bit more about, what we could see maybe on Biden's policies around green industries. I think we talked just a little bit about that, but any comment on that, Dave?
Well, I don't think you're going to see in a divided Congress, if in a Biden administration, I don't think you're going to see a lot of tax changes there that would stimulate there. There probably could be some things done on the regulatory side, but it's going to be harder. I think that's going to be over time. And you're seeing some states like California that are basically mandating, more green stuff just at the state level. And you could see some extensions of tax credits on green energy stuff, some of those that are set to go down or expire over the next few years. Because I think overall, I mean, people like to see, of more, renewable energy. The question is, can you do it through tax policy? Probably not in the next 2 years.
Yeah.
So.
Yeah, I think it would be possible that part of the infrastructure deal we get is some kind of an incentive like what we saw out of the Obama administration back in 2008, where they were doing incentives for car buyers, people who bought hybrid cars at that point in time. We might be able to see the same thing with the electric cars.
Potentially.
Remains to be seen.
Well, we got a next couple interesting months ahead of us, as always. So 2020 has been really interesting, to say the least.
So we had one more question come in. Any thoughts on the whole onshoring or offshoring of manufacturing as it relates to, some of the trends that we've seen historically? Do we see some of the manufacturing maybe changing going forward?
Like more coming back to the United States type of thing, or less? Is that what you mean?
Well, I think the question is, are you going to see more coming back to the U.S.? And you would think that this pandemic would have, sort of pointed us of certain things that we need that are critical, other than toilet paper, that we make, here in the U.S. If you look at the trade deficit for trade goods, we're not seeing that. What we're seeing is yes, stuff moving out of China, but it's going to Vietnam or Indonesia or Malaysia or the Philippines or some of those countries. So I think it's getting distributed around, so we won't be as dependent upon China. But the problem that you always end up is coming back to the U.S. is nearly always more expensive. So until we do more on the automation so that we can reduce the labor costs in the advantage that the third world countries have, it will be hard. I mean, I think everybody remembers, Walmart 15, 20 years ago having this thing of Buy American, and, we're going to label everything. If it was made in America, we're going to label it. Well, it failed miserably because it was more expensive. And people like to say, oh, I'm going to buy American, until you say, okay, it's 20% more, hand me the money. And then they, I'll take the other one. So there may be some critical things that on the pharmaceutical side, you may see some of that, because some of that was nearly solely sourced in China. And I think people want to diversify. And it may be that it's sourced in 5 different countries instead of 1.
So I think we're getting to the top of the hour, and I think we've gotten through most of the questions. So I want to thank everybody for your time today. If we didn't get to your question, we'll definitely follow up with you directly, make sure that we close all of that out. So the webcast today is being recorded, and we'll publish it up on our website soon. So if you know anybody that might benefit from our discussion today, please point them in our direction. We'd really appreciate it. So hopefully you found this helpful. When we close out this webcast, you will be presented with a short survey